Form 8853, Archer MSAs, and long-term care insurance contracts. So there are several parts to this tax form, and a lot of people will not use it, particularly those who don't have an Archer medical savings account or a Medicare Advantage medical savings account. But we're going to go through this for those of you who do. There are 3 sections. So Section A has to do with Archer MSA, and it's broken down into 2 parts. Part 1 is the contributions and deductions portion. Part 2 is the distributions portion. Section B is the Medicare Advantage MSA distributions portion. And then Section C on the back is the long-term care insurance contracts portion. So there are certain filing requirements, and we'll go through this form, but all the details, you can find them in our article. We'll put a link in the show notes, or you can simply go to teachmepersonalfinance.com, type in IRS Form 8853, and the article will appear. So let's go to the very top. We've got our taxpayer, John Doe, his social security number. So there are specific instructions if both spouses have an MSA. And again, if you're not already grandfathered in to MSA contributions, you're most likely going to be focused on health savings account, and that's a different tax form. That would be IRS Form 8889. We'll put links into the show notes to those resources. So with Section A, we're going to talk about Archer MSAs. If you only have a Medicare Advantage MSA, then you can skip this section and go straight to Section B. So in line 1, you put the total employer contributions to your Archer MSA for the tax year. And then basically those will offset any deduction that you can make for the Archer MSA contributions that you actually make. So if you have an account where you're responsible for 50%, or your employer matches, then the employer match may offset some of the deduction from your contribution. So lines 2, 3, and 4, if you recall, the smaller of these 3 lines is going to be the amount of your actual contribution. So in line 2, that's the amount of total contributions that you made for the year. That includes any made in the next year for by the due date. So kind of like an IRA, where you can make, even though at the recording time of this recording, the latest tax form is the 2023 version. Let's imagine we're doing this for the 2024 tax year. If you made contributions in 2025 in, like, say, March, you could still claim that for the 2024 tax year. Don't include any rollovers. That would not be considered part of a contribution. For line 3, there is a limitation chart and worksheet in the form instructions. I'll briefly go over it. Basically, it is right here. It's kind of a flow chart, and it talks about how much, based on whether or not you were enrolled in Medicare, whether or not you had coverage under a high deductible health plan, and it kind of goes through the requirements of that coverage, and then you can actually create the limitation by going through this chart. So let's imagine that we did all that and our limitation is actually $3,000. And then finally, the last variable is your total compensation from the employer that's maintaining your health plan. So let's say that John Doe, he contributed $200 a month. For some reason, the limitation came out a little bit higher, and then his compensation was completely, well above any of those numbers. So you would take the smallest of those numbers and you would put that in here. That's also the number that you would include on line 23 of Schedule 1. So that would be specifically, that's the amount of of the deduction that you can take above the line. So now there is a note if for some reason line 5 is greater than line 2, which means that you either exceeded the limitation or on how much you could have contributed to your to your MSA, or your income from that employer was less than your total contributions, then you may owe an additional tax. So real quick, I want to circle back to the employer contributions before we move on to part 2. So if you're curious, and I have had this question in previous videos, if you're curious as to where this number comes from, you would find it on your Form W-2, Box 12, with the code R, and that signifies that it's an Archer MSA contribution. So the additional tax for line 5, if you do have to pay an additional tax, that would be on IRS Form 5329. You would do the calculation on there and attach that to your tax return. And again, to reiterate, any forms and schedules that we mention here, we will make sure to put them in the show notes for future reference. So in part 2, Archer MSA distributions, basically you're going to figure out how much of your distributions are taxable, and then if they are taxable, do they or do they not meet any exceptions for the additional 20% tax that may be imposed on taxable distributions. So for most people, if you only take out the amount of distributions for qualified medical expenses, then you're going to be fine. Okay, so just keep that in mind. That's the underlying principle here. All of the rest of this is simply calculation. So in line 6A, we're going to enter the total distributions that you receive from all Archer MSAs. If you're married, that would be both spouses. And you can find that on Form 1099-SA, line 1. So the does do that, and it's $5,000. Line 6B includes any distributions that you rolled over into another Archer MSA or a health savings account. So you would also include any excess contributions that you withdrew before the due date of your tax return. So let's imagine that the does $5,000 worth of distributions, but really only 4,000 of those. 4,000 of those were rollovers to a new health savings account, and then you subtract those, and that really means only $1,000 of distributions that were applied to or possibly applied to medical expenses. Now, in line 7, unreimbursed medical expenses. So generally speaking, anything that you paid out of pocket, that doesn't include costs that were covered by insurance or by your employer. This would be, hey, I wrote these checks for these deductibles, for these medications, for these exams, whatever the case may be, and they're clearly above, like they came out of your pocket. So let's say that in the does instance, that was $2,000. So you subtract that amount from line 6C. If it's 0 or a negative number, it's 0. You would also include that in Schedule 1, line 8E. That represents the additional income from any Archer MSA distributions. Let's imagine that this number ended up being $4,000. You would now have $2,000 of taxable distributions that you would report on line 8E. And now we need to determine if any of those distributions meet the exceptions to the additional 20% tax. So for Archer MSA distributions, the additional tax applies unless one of these exceptions applies. And there are 3 exceptions. Exception in the case of death. So if someone passed away and you're making distributions out of their Archer MSA account, that's an exception. Disability, like a permanent disability as defined by the IRS. The third one would be if the person is age 65 or older. So if you do that, you can check this box and you don't have to worry about line 9B. But if you can't check that box, then you would enter 20% of this amount and that's going to be subject to the 20% additional tax. This number goes on to Schedule 2, line 17E. Schedule 2 is the additional taxes form. So Section B looks very similar, except it's for Medicare Advantage MSAs. So if you don't have a Medicare Advantage MSA, you can completely skip this. If you are filing a joint return and both spouses receive distributions from separate MSA or from a Medicare Advantage MSA, you would need to complete Section B separately for each spouse. So let's kind of walk through this again. Let's say that the distributions were $5,000 from all Medicare Advantage MSAs. Let's imagine that line 11 is $3,000 worth of unreimbursed qualified medical expenses. So the line 12 is the taxable amount of your Medicare Advantage MSA distributions, and you subtract line 11 from line 10. If it's 0 or negative, you would enter 0 here and in Schedule 1, line 8E. Basically the same line that you would report these taxable Archer MSA distributions. So there is a 50% tax on Medicare Advantage MSA distributions that applies with two exceptions. The exceptions are in case of death or disability. So because generally speaking, everyone on Medicare by definition is age 65 or older, there is no exception for being age 65 or older. So I think the intention is to steer people with a Medicare Advantage MSA into only spending their taxable distributions for medical expenses. So unless a spouse passed away or someone else in the family and you're spending out of that deceased person's account, or if there's a permanent disability, then there are no other exceptions. But you would basically calculate the additional 50% tax by calculating 50% of this line 12 number, and you get $1,000. You would put that also on Schedule 2, line 17F, which is a different line from the line 17E for the additional tax on Archer MSA distributions. So before recording this video, I did not fill in this Section C, so we're going to be just walking through this. So the name of the insured, let's just say that it was, let's say that we did this for John Doe. And then, there are filing requirements. Let's briefly go over those. There are definitions in the form instructions. We also kind of cover those in our article. We also have this flow chart for the filing requirements. So basically you start with a flow chart, and the yes/no questions kind of guide you to whether or not you need to complete Section C in its entirety, certain lines of Section C, or you don't need to complete Section C at all. So that's kind of the visual. You can see that in the article as well. So let's imagine that we're completing the whole thing. In the tax year, did anyone other than you receive payments on a per diem or other periodic basis under a life insurance contract covering the insured, or receive accelerated death benefits? So you hit either yes or no, and based on that, you can determine whether or not special rules do apply for accelerated benefits or in excess of per diem benefits. And then if the insured was a terminally ill individual, if yes, basically, generally speaking, I think that definition is 6 months or like a terminal illness. So there's not a definition in the IRS website, but if there is a terminal illness diagnosis, then and the only payments that you received were accelerated death benefits because of this, then you can just go all the way to the bottom. Nothing is taxable. So nothing is taxable for a terminally ill individual. So let's just say that these two are no. Enter all the gross long-term care payments received on a per diem or periodic basis. Let's say that John Doe received $100 a day for 365 days. There we go. That would be it. You could see the total of the amounts from box 1 on all forms 1099 LTC. And then the box 3 would be checked to indicate per diem. So don't use lines 18 through 26 to determine the taxable amount of benefits under an LTC contract that isn't a qualified one. So if the benefits are not excludable from your income, then you would report the amount that as income on Schedule 1, Line 8E, or Schedule NEC for people that are filing Form 1040-NR. So basically, what this is saying is this is only for qualified long-term care insurance contracts. It's either includable in your income if it's not qualified, if it's not paid for personal injuries or for health, for health insurance. But then you would complete this for qualified long-term care insurance contracts. So let's just say that all of this is from a long-term care insurance contract. We'll assume that there were 0 accelerated death benefits on a per diem basis, and then we'll add those up. So basically $36,500. If you checked yes on line 15 above, which we did not, then that basically means we're having to go through special instructions for multiple payees, which means you're kind of doing this for a couple of times and you're having to prorate the payments for each person. So $420 multiplied by the number of days in the long-term care period, which in this case is 365. And that comes out to $146,000. Let's say that John Doe, he pulled out $36,500. The costs that were incurred were actually $40,000. So you would enter the larger of these in here, and then any reimbursements for long-term care services. Let's imagine that he did receive any. Let's first imagine that he didn't receive any reimbursements. So the per diem limitation is you subtract this from line 23, and then you subtract this amount from line 20. That basically means that there's 0 income. And if you walk through this, that kind of helps you understand, hey, I pulled $36,500 out. This is the limitation based on what the IRS says I can exclude on a number of days for a per diem basis. That's kind of the way long-term care insurance contracts usually work. So if I actually pulled that money out and then I spent it on long-term care services, then it makes sense that as long as I didn't go above the $420 per day limit, I should not have to pay taxes on it. Let's say that John Doe had a lot of money in his account or in his long-term care insurance contract. He got grandfathered under a contract that pays him $500 a day. It's pretty rare, but let's just imagine that he did all of that. And so now, let's say that he actually spent $150,000 on that care, and we're entering that number here. So now the per diem limitation is $150,000. And that means that 32,500 of this would be considered taxable income. That would get reported on Schedule 1, line 8E, the same line that you would enter this information if this wasn't a qualified contract. So to summarize this for anyone that's completing Section C, if your LTC contract isn't qualified, you're automatically going to report whatever amount you pulled out. If it is a qualified contract, then you're going to go through these calculations based on the IRS per diem rate. And then if your long-term care insurance contract was paid you more than that tax-free rate, then you're going to pay taxes on the difference. So that's generally the basic principle. I don't see that happening to a lot of taxpayers based on my experience with long-term care insurance contracts, but it is possible. So those are the three sections of IRS Form 8853. As I mentioned, we'll put links in the show notes to all of these resources. So if you are if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions, comments, or if you'd like to see, if you have a question that you'd like to see addressed in an upcoming video, please hit me up in the comment section. Thank you very much and have a great day.